Welcome to the daily update where I'll go over the action in the market for Monday, April 21st, and we'll see how things look for Tuesday, April 22nd. Yeah, okay. If you watched any of the weekend videos or the daily video for Monday, we are negative, and that was even more reinforced in Monday's session. The futures ended up gapping lower. Europe was closed. Apparently, they're closed the Monday after Easter, but in the US, we were not looking very solid. Then this didn't really have any impact on the stock market per se, but then the news of Pope Francis passing away, that hit. Certainly didn't help people that are Catholic to feel much better about things, most likely. And we just kept staying negative. And then right when we opened in Monday's session, we hit the ground down and just kept going. And there's a lot of concerns about, okay, what's this little spat that's going back and forth between Trump and Jerome Powell? That is having an issue with, okay, can we have confidence in the Fed? The Fed's supposed to be independent, and it's not supposed to be political. And not to say that it hasn't happened over the decades before, but in theory, that's what's supposed to happen, but it's causing a lack of confidence. And then, of course, what's the fallout going to be with the tariffs and the policies and all those different things that are happening there? And so you have a market that is more prone to selling right now than buying, but who knows? Tuesday could be lots of buying. Quite volatile these days and really hard to get a handle on, okay, are we looking better and starting to go up, or are we looking worse and starting to go down? We're still above some major long-term support, getting a little closer now, and we tested that recently. Are we going to go down and test that again? Is that test going to be successful? But in the meantime, we are negative in the short, intermediate, and long term. Okay, so right at the open, we had a gap lower, and we didn't even touch S1. That's the higher support level. Didn't even get there. We started at S2 at 52.16, and then we went down to S3 at 51.43. And we just kept going. We just kept going all the way down, and we finally found support around the 5,100 level. Came down to that level, bounced up, came back down, tested it twice, and then we're able to close back up above S3. So we were down 2.36% on below average volume. You have a real lack of conviction now that, okay, the market goes up, the market goes down, but we're not seeing a lot of volume really supporting this. And as I said, we are negative in the short, intermediate, and long term. Inflation doesn't seem to be a real issue right now. Interest rates did go back up, and I'll cover that here in just a moment. It's more the political and geopolitical things and policy and trade wars and arguing between the executive branch and the Federal Reserve. And that's just causing a real uneasiness right now. Okay, so some comments. There was a warning from China urging nations to steer clear of U.S. trade deals. Man, don't do any business with the U.S. if it's to the disadvantage of Beijing, which is the capital of China. Along with talk that President Trump's team is exploring whether he can lawfully remove Chair Powell from the head of the Fed. Now, he appointed him, but it's not like they hang out much these days. And the VIX is back above 30. It was a little bit more positive after last Thursday's close because we didn't have a session on Friday where we closed just a little bit under 30. And again, anytime we're above 20, that's negative. But when we're above 50 with the VIX and then we come down below 30, that can quite often be positive, but not necessarily positive right away. It can take some time for that to work out. But we did go back up above 30 with the VIX at 33.82. And we still starting to see more of a list developing here in the short term. Those things that are extreme negative, which is in this case is showing more negative momentum. We're getting kind of far away with the 20 period exponential moving average on the S&P. Both the rate of change based on 5 periods and 20 periods are extreme. The 10 is still going up. And because it takes whatever that closes and then counts the number of periods back, and that's how the rate of change is determined. And so the 10 didn't get counted here, but the very short term rate of change 5, and then kind of the longer of the short term is based on 20 periods. We're still extreme negative with the slope oscillator, the MACD, even though these some of these are improving, and we're far away from the 20 period moving average as measured by the boom indicator. Getting a little bit longer list here, both in the intermediate term as well as what I just went through in the short term. We're extreme with the 50 period exponential moving average of the S&P, the rate of change intermediate term based on 50 periods, TTM squeeze, the PMO, the Sean trend meter, the Copic curve. And a lot of these are momentum oscillators, and we're far away from the 50 period moving average as well. Long term, we're getting kind of far away on an extreme reading with the 150 and 200 period simple moving averages. No change to the overall scenario. There's kind of a different scenario that's working its way out right now of this little battle that's going on. The dollar was down. It's continuing to fall. It's 100 and falling from there. And folks are getting a little bit concerned about that because in this kind of an environment, you would expect the dollar to go up with the tariffs and with the changes that are taking place. That's more protectionism for America. And when a country does that, their currency has a tendency to go up. We're seeing just the opposite of that right now. And interest rates did go back up. We're at 4.41% with the 10-year yield, where after last Thursday, we were at 4.33%. And we actually ticked up a notch with sentiment. It's like everybody's negative. What's more to be negative? We came in at 22, where after last Thursday, we were at 21, even though we had a pretty significant down day. And we're back to seeing a strengthening trend now. We're crossing above the moving average with the ADX. The red line's above the green line. That's negative. And I should have changed this. It's actually above the moving average now. But I did change the word strengthening here. And with the down day, our bias is negative. And then the last number of days taken together, our momentum is negative as well. Okay, we just had the leading indicators, and I'll have a couple of charts to show you there. It was down 0.7%. That was weaker than the minus 0.4% they had expected, and also weaker than the last reading where it was down 0.2. Here is the chart. It just says there were further declines in March with the LEI. Now there's the blue line, that's really the one that we're focused on right here. That's the leading economic index. Where the coincident, those are more things kind of right now, where the blue line, that's trying to project out into the future, how they think things are going to go. And we're seeing a weakening here. And then when we look at this, the growth rate, we're still above the red line, even though we're starting to turn back down. We had been seeing this improving, getting back above the red line. The red line is where there's a warning sign that we're possibly going to go into a recession, which is typically what's happened if you look at other times when we drop below the red line. This last time we did go below the red line, but there was no recession. And then we're starting to improve, coming back above the red line again. So it's coming down, but we're not down to the red line at least yet. Okay, then the best and worst days are usually close to each other. Yeah, it's when you see a really volatile market. We have a big down day followed by an up day, or an up day followed by a down day. Well, now last Thursday was virtually unchanged, and then we have a down day on Monday. But last Thursday was also options expiration, and then of course the market was closed for Friday. So it's just showing that we tend to see an awful lot of movement together, either up or down at certain times, and this goes all the way back to 1928. Then margin debt, it is coming down a little bit because this is in a way a sentiment gauge, because when you use margin to buy stocks, you put up half the money and then you borrow the rest of the money from your broker. And as I always say when I go through this, it's not a partnership. So if the value of your stock goes down, you still owe all the money back to your broker that you borrowed. It's not like, well, let's split it 50-50. You take your loss, I'll take mine. And that's not how it works. So margin can be a really good thing when you're right. It can be very dangerous when you're wrong. So there's two sides to this. And as the market's been coming down, we are seeing some of the margin debt start to decrease as well. And this is put out by FINRA, and it's based every quarter. And since we just finished recently in March with the first quarter, they're starting to come out with this, but we're not really getting any kind of an extreme reading right now. Then S&P 500 returns a year after a spike in policy uncertainty. Yeah, a lot of times, okay, it usually starts off more negative, and then as people get used to this change, looking out into the future, there seems to be more confidence, especially if that uncertainty produces things that is considered to be positive. And then the US True Financial Conditions Index as opposed to the false one, I guess. And this is coming back up a little bit above the dashed line here. We're coming in at a reading of 6. And this measures housing affordability, the yield curve, money growth, loan standards. It kind of takes it all together. And it came out last week, and we're just showing a little bit of an improvement here, and that could be positive for the market, but that didn't happen on Monday. And then we're not in a recession yet, but there are some charts starting to come out, like this one from Yahoo Finance, saying that typically the S&P falls further in recessions. Okay, well, yeah, I mean that kind of makes sense, but we're not in a recession right now. But when we do go into a recession, if that ends up happening, then that's when the returns can get even worse than what they've been now. And then the recent stock market underperformance will likely turn the wealth boost to consumption into a drag. This is just showing here the contribution to the PCE growth. And that's kind of the variation of the CPI, and just where equities, real estate, and then the total reading here, where the move down in stocks, that's what's weighing things down a little bit here, according to this chart. And then market swings calm down after a manic stretch. Okay, tell that to Monday, where the S&P 500's range has narrowed after a wild 2 weeks. Tell that again to Monday. It just didn't happen that way. And then this is from a little different source, but I still included it in the section with Isabel Net charts. Safe haven flows are safety dance index. Now, how would you like to have an index like that? Where it shows the flows into gold, because gold is seen as a safe haven or a hedge against insanity. Treasuries, bonds are considered to be safer than stocks. And low volatility stocks like toilet paper, toothpaste, those stocks that tend to hold up better, they combine this into the safety dance index, and it's getting pretty high. And if you watch the videos that I do regularly, we've been seeing that in other charts as well, and it's just kind of confirmed by this particular index. And then earnings revisions, where they still tend to be popular, and we're coming into the main part of earnings season. It got kicked off, and a few number of companies have reported to this point where there's going to be more and more. But we're seeing earnings revisions, which may still be popular with the earnings, but they're revising them down because of concerns about the economy and the whole uncertainty about tariffs and things like that. So that's why you're seeing this coming down. And we started to see that in late 2024, actually, and that's when it seemed like the stock market was really running out of steam. That was one of the factors that was coming into that. Okay, so here is not a really pretty day. We did see a little buying going into the close, which is often considered positive, but it could have been some short coverings just getting out of their positions. But we gapped down. Well, we didn't even touch S1. We started at S2, dropped below that, came down to S3, and it looked like maybe we were trying to stabilize a little bit here. No, we went all the way down to 5,100, a round number. And then that's where we went up a little bit, came down, kind of tested that area again, and then saw some buying going into the close. So we did settle off the lows, but it was still a very negative day. And we are up a little bit in the initial overnight session for Tuesday, but Europe wasn't open on Monday, and so we didn't really get much of a push there, even though the futures really started to go down, and then it just carried over into the cash session. Not seeing any kind of a lead here between growth and value on the intraday chart. The blue line and the red line are pretty much on top of each other, and we're not really seeing much of an improvement when we look at S&P growth to value, the intraday chart. The red area here, this just shows that we're not improving, and that is more negative for the market. End of day growth was down 2.82%, where value was down 1.94. So, I mean, they both got hit, but growth got hit even more. It got hit more with the mid caps as well as the small caps. So, we look at our growth to value ratios for the small caps coming back down here, showing some weakness, dropping back below the 200-day moving average with mid cap growth to value. And we're in a downtrend now, and we're below both moving averages with S&P growth to value. That just shows a market that's getting more defensive, that is usually getting ready to go down. And we're also back well below the rainbow here with this growth to value ETF. That's more defensive. And then looking at discretionary, the equal weight version, and I have another variation of this chart to show later on, we're seeing a death cross here. And that's now the equal weight discretionary, that means they're taking out things like Amazon and Tesla. It's treating all the stocks the same. And this is not very strong, where this was one of the better performing areas from about halfway through to the end of 2024. It's been one of the worst performing areas so far in 2025, where the staples aren't doing all that great, but they're holding up better. And so when we do the ratio between discretionary and staples here, we're going down with this ratio, and that's negative for the market. This is one of the new charts, which the top area here, this is a ratio, and I hope it's not too small to see. I can try, let me see something. No, there, I can try to resize this a little bit. And this just shows the regular discretionary to staples ratio. So it's weighted. And it just shows when we're going up, we are more defensive in these areas. Okay, I guess I'm going to keep it smaller here so I can have my pointer going. When we're going up, that's more offensive. That's growth. That's the market's going up. Well, now we're going down with this ratio, and we're seeing pretty much that same thing. We look at the equal weight staples versus discretionary, and that's the same chart that I just showed. Shows that we're getting more defensive here. When you do a ratio between the tech sector and utilities, tech is growth, utilities are considered to be more value or more low volatility type stocks. We're going down that way. You look at biotech, which is like the growth part of healthcare, and then compare it to healthcare itself, that's going down. And then hotels, where, okay, you don't have to have in a hotel. You can just decide to go camping or stay in your house or what have you. That's considered to be a luxury item, a discretionary item that when things get more difficult in the economy, it's one of the first things that gets crossed off the list. Where utilities, you have to have those. You've got to have water, power, and things like that. And so we're also seeing this ratio continue to go down. So this is kind of a discretionary to staples type ratio as well, but a little further down into some industry groups. And you can see there's a theme across the board here. Looking at the trend, we are starting to go back up above the moving average with the ADX. This is intermediate term, and we're negative because the red line is above the green line, and the red line's going up where the green line's going down. Short term also starting to turn up above the moving average again. That shows this, the trend is getting stronger, and the red line is above the green line. So the short term is negative. And we're dropping off with volume here. But the oscillators really been coming down. And you can see for the last number of trading sessions, we're below average with volume for the S&P. And this is the weekly chart sentiment actually improving up to the neutral area. Not what we're seeing on our other charts that we look at. We're still extreme negative there. But this is coming in at 45.35. We're still looking a little more bullish here when we look at legal insider transactions, like CEOs and corporate officers that buy or sell their own company stock, and they have to report that. And so we can get a sentiment gauge from that. And when we're getting the reading where we're at right now, that tends to be more positive for the market. Didn't really help on Monday. We're still getting a very high reading here with this sentiment gauge, the Ulcer Index. And we're back above 30 here with the VIX. Going back up here, we're well above 20. That's when things are more negative. But over the weekend, I was pointing out that when we get above 50 and then drop down below 30, that can be positive. It hasn't worked out that way yet, but we'll see if that means something going forward from here. And then the VIX of the VIX, which measures the volatility of the VIX. Typically, when the VIX is going up, the VIX of the VIX also goes up as well. But the momentum for the VIX is still down after really spiking up here, getting up to 60 and then dropping down. The MACD picked that up and it's still giving us a downward momentum. And we went up with this fear gauge, and we're also going back up with this other fear gauge. So we're seeing some confirmation there. We're continuing to go down with the risk on versus risk off ratio. That's negative. We're getting more risk off, which is negative for the market. And then the high beta versus low beta ratio, that continues to be going down here, which is more negative for the market. And we saw a real spike up, which was interesting. You look at Thursday's daily equity put call ratio chart, it actually went down, which was strange before a 3-day weekend, a holiday weekend, leaving yourself open to all kinds of crazy things that could happen. Fortunately, nothing really did that was market shaking anyway. But then in Monday's session, we saw a real spike up here as folks are starting to hedge using more puts right now in their portfolio to protect themselves. And so we're going up with the 5-day chart, and not real pronounced here, but we did tick up slightly with the 10-day average chart. We're still getting a very low reading, though, with the volatility risk premium, well below the band, and it's continuing to fall. And we probably overdid it here with the advanced decline line percent, getting an extreme negative reading, and the advanced decline ratio, also an extreme reading. Just this is just the daily chart from one day to the next. And we're still seeing a mixed picture here. The advanced decline line based on price is still above the moving average, and we're below the moving average based on volume. We actually ticked up a little bit with the advanced decliners over the last 10 days. This it's still negative since it's below zero, but it did tick up a bit here. And then we're below zero with the short and intermediate term advanced decline ratio and not seeing really any improvement here. The improvement that the 10-day moving average is picking up, that's more the contraction of the new lows because we're not really seeing any new highs at all here. But even with Monday's downturn, we didn't see all that much of an expansion of the new lows. And we're starting to drop below the moving average here with accumulation distribution. We're negative with the Chaikin money flow, and we're negative and dropping below the midpoint with the Chaikin oscillator. We're negative with the vortex, and we're showing more weakness with our advanced decline line studies with all the different indexes and starting to get extreme negative again with those stocks in the S&P above their 20 period moving average, 50 period moving average, 100 period moving average, not quite extreme yet, and extreme here with those above their 200-day moving average. Very weak right now. So here's the daily chart showing the recent death cross as the 50 period moving average goes below the 200, and we're dropping down here below this pivot point, and we are dropping off with volume as well. We're getting extreme negative with the 20 and 50 period moving average study, still going down with the 200. No longer extreme positive, believe it or not, with the nice little up move here. The Stochk RSI was getting all excited about that. Well, with Monday's decline, that is no longer extreme. We're dropping further below the midpoint with the Williams percent R and declining with the CCI 14 and the CCI 20. No extreme readings now in the short, intermediate, or long-term stochastic. And going back and looking more negative with the force index and starting to get extreme negative here with the rate of change going back 5 periods. That's dropping below the red line. The condition of the short-term trend, it was trying to stabilize here. Now it's starting to go back down. That's more negative. And the rate of change based on 20 periods is dropping further below this pink line, getting extreme negative. We're dropping back down further below the midpoint, and we're in the -2 standard deviations channel. But we're still going down here with this truflation. This is just another way of measuring inflation where it is coming in under that 2% target that the Fed has. Intermediate term, the balance of power is below the midpoint and declining. That's negative. We're back to a deep purple now with the go, no go. That's negative. And we want to keep an eye on this. We're still in correction territory, but if we go up over 20% on a closing basis from the February all-time high, then that's going to be a bear market. So we're already in a downtrend, but we're still in corrective mode for the time being. If we do get down to a 20% decline, not only will we be in a bear market, but we'll also already have been in a downtrend. And here, dropping further below the midpoint with the lowest low value now, but not really reaching an extreme reading there. TTM squeeze, it's turning back to the darker red, falling below this black line. This gives it a little bit more context. You can see the readings here have not been very positive lately with the TTM squeeze. And okay, did I hit the wrong button? Okay, in case you missed it the first time, here's the rate of change 50 period chart. Coming down with the standard deviation, but still getting a very high reading. That's measuring speed. And still below the midpoint, declining with the ease of movement. That's negative. We're negative and flat right now with the Arun indicator. And we were after Thursday, we were slightly above zero with the S&P McClellan oscillator. Now we dropped down to below zero. So we're starting to go down with the summation index based on price and volume. And we were positive with the NYSE McClellan oscillator. Well, after Monday, we're back down below zero. So it's really hard to see here. You could barely see it going up. Now you can barely see it going down as the market has been quite volatile lately. Now we're negative with the Swindler trading oscillator. We're declining based on price and volume, where we had been negative after last Thursday. Momentum just continues to be negative and extreme negative here with these readings. We're also negative when we break it out based on price and volume, showing some weakness with the PMOs that are rising, but not extreme. The buy signals had been improving, but now they're starting to roll over, and we're flattening out with the PMOs that are above zero. And we're negative with the Elders Impulse system for the S&P, where after Thursday we were neutral. We're still positive with the parabolic SAR. This is still one of the primary indicators because we've seen such big moves in here that it's still picking up things as being positive. But we're extreme negative and going flat with the slope oscillator. That's a short-term oscillator where we're still extreme. Even though we've been coming up, we're still getting a quite extreme negative reading with the MACD. It's starting to roll over and it could start to cross back below its moving average. So we look at all of our momentum oscillators. We're negative with the slope oscillator. We're positive, believe it or not, with the TSI, but now that's rolling over. We're showing weakness with the MACD, PMO, and PPO. We're still negative, and we never did turn positive with our long-term oscillators. The copy curve is trying to improve, but it's still below the red line, another momentum oscillator. And this just gives a longer term look here to show that we're getting an extreme negative reading there. The Sean trend meter is back down into this pink area, which is extreme negative. And we're actually crossing above 50 with the money flow. It's kind of interesting there, where we're dropping further below 50 here with the ultimate oscillator, still below the moving average with on-balance volume. And now the red line, the moving average is declining. That's more negative. We're below 50 with the RSI 14 and the RSI 9. That's negative. The condition of the intermediate term trend is still weakening here with the blue line and the red line declining. And we're below all the moving averages, and the shorter term moving averages are really coming down. We're far away underneath the 20 period and 50 period moving averages measured by the boom indicator. And we were positive with the bullish percent index, not after Monday. We came and declined, and we're back down below the moving average. And we're getting extreme negative with the NYSE bullish percent index and turning down, but still above this red line, which would be an extreme negative reading with the NASDAQ 100 bullish percent index. This is another area that we've been watching the dynamics. This is the SPY, which is the S&P, to staples, which is toilet paper and toothpaste. And I went over this in a lot of different weekly videos. I just want to keep an eye on this because this breakdown that we're seeing now, we saw something very similar right at the end of 2021 before we went into 2022. This ratio is continuing to fall, meaning the market is getting more defensive. And we were in a cyclical bear market in 2022. Mass index just kind of waiting to see. We had one signal that was triggered, didn't really turn into too much. Now we have the potential of another signal being triggered. We'll have to see what happens there. And we are just a little bit above this 38.2% retracement level. Are we going to go all the way down to this 50%? Now we came down here, there was a short stay, and we bounced out of that. Are we going to keep falling and come back down to this area again? And then what's going to happen if we do? Are we going to continue to go down even more below that? That's going to be another potential test of longer term support if we even get down here. And this is another long-term chart, a weekly chart of the S&P. We're still holding up above this S1 support level, even though we were down. And we're still above the midpoint with this trend channel going back to 2009. So longer term support for right now is still holding. And we're also holding above this trend line going from 2022 to the 2023 lows and then just extending that forward. And this is another newer chart. We want to keep an eye on the SOX index. These are the semiconductors, and this is a weekly chart with a 200-week moving average. Now, in my opinion, and others, I got this from other people, but I also agree with it. This is the ultimate long term, the 200-week moving average. That's the definition between a secular, which is very long-term trend, and that's what the trend is here with the semiconductors. It's still in an uptrend. You can see the blue lines going up. Now, the shorter term bear markets that we get into are classified as cyclical bear markets. And there's subtle differences between the two because like 2022, we were in a cyclical bear market within the context of a bigger picture secular uptrend that was happening. And we're coming down to this blue line and we're starting to drop below it. And so this is a bit of a concern. In tech, the semiconductors, which is the SOX index, they're a huge part of tech. Tech is a huge part of the stock market. If tech is suffering and semiconductors are suffering, the stock market is suffering. And so we just want to keep an eye on this one. Then we are negative with the Heiken Ashi. We're down with the black candles. We're red and pointing down with the Kegi chart. That's negative. We're still positive with the Renko chart, and we're still positive with the three line break. Yeah, how's that for conformity? All right, and we did see some new red zeros drawn in here. That's negative with the point and figure chart with the decline that we saw. Long term, we're getting further below this green line. And I just put this on here. It's 150, it's at the 150 level. It's just to give us a reference point. Are we getting kind of extreme here? And we are dropping further below with the 150 and the 200 period moving averages. And we're negative across the board on all time frames with all stock indexes now. And we're negative across the board, except commodities are still positive in the long term. All the sectors ended up being down. Staples were down the least, and that we want staples to be down the most if we're positive on the market. So even though they got hit less. And then we had healthcare. It got hit pretty good. But then you see communication, tech, and discretionary. These were three of the weaker areas. That's growth. And these are the areas that are now underperforming. An awful lot of red as we just kept going down, down, down. And we started off not looking very good with discretionary having a BPI cross above below 30, which it had just crossed back above 30 not too many days ago. And then we had a BPI cross above 30 with the NYSE. That's an index that's been holding up a little bit better. We had a BPI cross above the NASDAQ with the NASDAQ above 30. And then the NASDAQ got above 16.4. So they were trying to show some improvements here. Then we saw materials, which is more cyclical. They go with the economy. That was improving. And then everything kind of got not very good, where we had a BPI cross back below 30 with the NASDAQ, where we just had one earlier going above 30. Discretionary showing a 5,200 moving average crossover. And then the NASDAQ going down below 16.2, 16.1, 16,000, 59, 15.8, 15.7. And then we had other bad things happening. The staples, which, again, it would be better if these actually showed some weakness. They had a BPI cross below 50. Healthcare, another defensive area, also showing weakness, broke below 5,200, but so far for the S&P, the 5,100 level is holding. Utilities got hit too. That's another defensive area. Canada was even having a rough time. The tech sector had a BPI cross below 30. Communication, that's a growth area. BPI cross below 30. Seeing a lot of technical damage done here. The NYSE BPI cross below 30, where earlier in the day it had a BPI cross above 30. So make up your mind there. And then we had a couple of things later on in the day with oil having it's starting to go up with a MACD crossover, and gold is now up over 34, well, 3,400 here. So I look at the ETF, and that's the price is a little bit different there. And the Dow was the last main index to actually show a death cross, and it ended up being down almost 2.5%. We're negative with the Elders Impulse system for the diamonds. This was one of the first indexes to cross over negative after the small caps and mid caps, where we're in a downtrend with the Nasdaq. We're going down with the Elders Impulse system for the Nasdaq 100, one of the later death crosses to occur, but it's now in a downtrend. Negative with the Elders Impulse system for the Qs. Momentum had been improving. Now it's starting to roll over, and we could be getting ready to cross below the moving average. Small caps just not doing very well, down over 2% in a downtrend. The Russell 2000 small caps were trying to show a little bit of an improvement here with the RSI, but it's still below 50 and in a downtrend. And negative after being neutral with the small caps looking at the Elders Impulse system. Mid caps also not looking very good right now. They've gone from neutral to negative with the Elders Impulse system. The Wilshire, recent death cross, not looking very strong now. Recent death cross with the total US stock ETF in a downtrend. Financial sector still hanging out below its 200-day moving average. And the more we hang out down here, the more quickly this blue line is going to come down. Now, financials have been hanging out or holding up a little bit better, but we're going to lose that unless we see some strength in this area. The FANG index getting close to a death cross here. Not quite there yet. Apple was down 1.94% and in a downtrend, down over 3% with Amazon getting real close to a death cross. Microsoft has already been in a downtrend, down 2.35%. Google is in a downtrend, down 2.31%. Meta holding on to a little bit stronger uptrend here, but it was down 3.35%. Tesla's now in a downtrend, down 5.75%. Nvidia in a downtrend, down over 4.5%. Netflix also looking a little better. It was actually up 1.53% above its 50-day moving average. And then seeing a little bit of a weakening here between US and world stocks, but still pretty strong correlation. Longer term, the correlation is continuing. It's slowing down, but it's continuing to get stronger. The relationship between US and world stocks. Then here's another newer chart. These are more just some indexes. Up on top is the SPY, which is the ETF for the S&P, which is in a downtrend now. And then we look at the semiconductors, which are going down. These are called bellwether parts of the economy. So semiconductors are a big part. Home builders. This was one of the weaker areas. You notice how this started to go down before other areas of the market, before the S&P even started to go down. There's a ratio chart that I look at um, between the home builders and bonds. And that was really breaking down as this was breaking down. But you can see we're in a clearly a downtrend here with the home builders. Transports have been weak. Retail, I'm going to start focusing on that a little bit more with some retail charts that I bring up from time to time because it's been holding up fairly well. So I haven't really focused on that. Well, if we're getting ready to go into a recession, and we don't know that, and I do periodic updates on the website that I have. And if you're interested in that, go join the website and you can watch these videos. But we will see a decrease in retail sales if we go into a recession. So we're just kind of keeping an eye on that. And then the regional banks too. This is Silicon Valley Bank, Republic Bank, and New York Community Bank that we've been seeing some weakness in this area as well. So you see a trend here? Yeah, they're all going down. Here's retail here. This is a ratio between retail and the SPY, which is clearly showing that retail's underperforming. Even though when we look at retail by itself, it had been holding up fairly well. So I wasn't all that concerned about it. But then when we started to go down with the S&P, this started to go down and we're in a downtrend here. And then at the bottom is an RSI showing that we're below 50. So the momentum is negative as well. And then this is a chart I have shown for quite a while. Staples, toilet paper, toothpaste against tech, which is growth. This ratio just continues to go up, which is more defensive, and that's negative for the market. Oil actually dropped down here. We're getting into the 63 range where we had been in the 65 range. The dollar continues to fall, and it's in a downtrend. And over the weekend, I showed the weekly chart. It's also in a downtrend. And then we're starting to go back up here with the 10-year yield. If that continues to go up, that could pressure stocks. But we're not really seeing a flight to safety right now. We're not seeing money coming out of the stock market and going into the bond market. If that was the case, bond prices would be going up and interest rates would be going down. And we're declining here with bonds based on price and not seeing really any strength right now with our growth to value ratios. When we look at the Qs to S&P, discretionary to S&P, large cap growth is underperforming large cap value. So the large caps, mid caps, and small caps all showing some weakness after they were seeing signs of improvement. This ratio is going up, staples to the S&P itself, and that's quite negative for the S&P. So what's our outlook for Tuesday? We are negative in the short, intermediate, and long term. All right, just to kind of put it in real simple forms there. We don't have any economic reports coming out on Tuesday. Of course, the geopolitical things, tariffs, the spat between Trump and Powell, is that going to escalate? Is that going to get under control? And then any of these other things can always come flying in at any given time and have an impact. So no reports on Tuesday. It's kind of a light week here. Wednesday, we'll get initial jobless claims on Thursday and then consumer sentiment on Friday. This is kind of the big day, which will be Wednesday for most of the reports coming out. Seasonality, though, is positive, but it's like seasonality, schmeasonality. The market's just not really paying attention to that. April is supposed to be one of the better months, and it just hasn't been. But if you go back the last 22 years, we're positive across the board with the Dow, S&P, and Nasdaq. But the the market has new problems that it's worrying about now. So we do see some positive seasonality here, but again, the market doesn't seem to be really paying attention to that. So we're now negative with our three smart money indicators. We're also negative with our longer term growth to value ratio, and we're back to being negative with the S&P and NYSE McClellan oscillators and summation indexes. Swollen trading oscillators back on the negative side here. We're still negative on a momentum basis for the S&P. We're back to being negative with the bullish percent indexes, the moving average studies, ease of movement is negative, ultimate oscillator, the vortex, and the long-term special K, which I don't show. Actually, I show that in the deep dive video over the weekend. So if you want to see that particular chart, please check out that video. But we only get one or two signals a year, if even that. And so there's really no need to show that chart. And then on the positive side, we're seeing some weakness here with discretionary to staples. We're actually seeing discretionary by itself showing a death cross. Excuse me, and we are negative. Parabolic SAR, excuse me, we're still positive here, but we're negative in the short term. The parabolic SAR is still positive, and the money flow is positive. The financial sector is it's weak and it's below its 200-day moving average, but it's still holding up better than some of the other areas. The momentum for the Nasdaq 100 another day or so, and that's probably going to trip back over and be negative. And we're waiting to see if this mass index signal is going to mean anything if we do get another signal there. So our conclusion, no changes here. We're short term, intermediate term negative, and we're also negative in the long term. Thank you. I hope you found this helpful. Have a really good day, and I will talk to you in the next video.